Welcome. Today we're diving into the concept of divisible income and how profits are allocated among partners in a partnership. After a partnership calculates its provisional adjusted income, or PAI, the next crucial step is figuring out the divisible income. This is the portion of profit that's actually available to be shared among the partners. Understanding this process is essential for both accurate tax reporting and fair profit distribution. Let's start by breaking down what divisible income really means and why it matters for every partner involved. Before we get to divisible income, let's clarify provisional adjusted income, or PAI. PAI is essentially the profit a partnership earns before any appropriations are made for partners. This means it's the accounting profit, adjusted by adding back non-allowable expenses and subtracting capital allowances. Think of PAI as the starting point for all further calculations. Only after determining PAI can we move forward to calculate the actual profit that's available for sharing among partners. Visible income, or DI, is a key term defined under Section 28 of the Malaysian Income Tax Act 1967. It represents the adjusted income of the partnership after deducting partners' salaries, interest on capital, and any other appropriations specified in the partnership agreement. Only this divisible income is shared among partners according to the agreed profit-sharing ratio. Importantly, while salaries and interest are deducted at the partnership level to arrive at DI, these amounts are still taxable to the individual partners. It's important to note that only the divisible income is actually shared among partners. This means that after deducting partners' salaries and interest on capital, the remaining profit is what gets divided according to the profit-sharing ratio. This approach ensures that each partner's entitlement is clear and that the partnership complies with tax regulations. Partners' salaries and interest are deducted for DI calculation but are still taxable to the individual partner, not at the partnership level. First step in computing divisible income is to start with the provisional adjusted income. This figure is calculated by taking the accounting profit, adding back any non-allowable expenses, and subtracting capital allowances. This gives us a clear adjusted profit figure that forms the foundation for all further calculations. It's crucial to get this step right, as any errors here will affect the final profit allocation among partners. Next, we deduct partners' salaries, bonuses, and interest on capital from the PAI. These are considered appropriations, not business expenses. By subtracting these amounts, we arrive at the divisible income. This step ensures that partners are compensated for their roles or capital contributions before the remaining profit is divided. It's a fair way to recognize each partner's input and to comply with the partnership agreement. Sometimes there are additional adjustments to consider. Losses carried forward from previous years can reduce the divisible income. Similarly, special appropriations like approved donations may also be deducted. These adjustments ensure that only the true distributable profit is shared among partners. It's important to review the partnership's history and any special items before finalizing the DI calculation. Once the divisible income is determined, it's time to allocate it among the partners. This is done according to the profit-sharing ratio stated in the partnership agreement. Each partner's share of DI is then reported as business income in their personal tax return. This step is crucial for both transparency and compliance, ensuring that each partner receives their fair share and reports it correctly for tax purposes. Let's look at a practical example. ABC Partnership has an accounting net profit of Rm 180,000. After adding partners' salaries, depreciation, and interest on capital, and subtracting capital allowances, the provisional adjusted income comes to Rm 227,000. According to the partnership agreement, Partner A and Partner B share profits equally, with Partner A entitled to salary and Partner B to interest on capital. This example will help clarify how DI is computed and allocated. Compute the divisible income for ABC Partnership. We start with the PAI of Rm 227,000. We then deduct Partner A's salary of Rm 30,000 and Partner B's interest on capital of Rm 5,000. This leaves us with a divisible income of Rm 192,000. This figure is what will be shared between the partners according to their agreed ratio. It's a straightforward process once you understand the steps involved. The divisible income of Rm 192,000 and a 50/50 profit-sharing ratio. Each partner receives Rm 96,000 as their share of DI. But that's not all. Partner A also receives a salary of Rm 30,000, and Partner B gets Rm 5,000 as interest on capital. So Partner A's total taxable income is Rm 126,000, while Partner B's is Rm 101,000. Each partner must report these amounts as business income in their individual tax returns. Common question is about drawings, withdrawals by partners during the year. It's important to know that drawings are not deductible at the partnership level, nor are they taxable to the partners. Drawings simply represent a withdrawal of profits that have already been allocated. This distinction helps avoid confusion when reviewing partnership accounts and tax obligations. If the divisible income is negative, each partner's share of the business loss can be carried forward to offset future business income, subject to tax rules. This ensures that losses are not wasted and can be used to reduce taxable income in future profitable years. It's an important aspect of partnership taxation that partners should keep in mind. Partners' salaries and interest on capital are deducted when computing DI, but these amounts are taxable to the individual partner. They are not deductible at the partnership level for tax purposes. This ensures that each partner is taxed on their total entitlement, including both their share of DI and any salary or interest received. When a new partner joins or an existing partner retires during the year, the divisible income must be apportioned based on the period each partner was part of the partnership. This ensures fairness and accuracy in profit allocation, reflecting each partner's actual involvement during the year. Always refer to the partnership agreement for the correct method of apportionment. Sum up: the formula for divisible income is DI equals PAI minus salaries to partners minus interest on capital and minus any other appropriations. Each partner's taxable income is their share of DI plus any salary, interest, or bonus they receive. This formula ensures that profits are allocated and taxed correctly, in line with both the partnership agreement and tax law. Summary: the process flows from provisional adjusted income to divisible income, then to allocation among partners, and finally to individual tax reporting. Divisible income represents the profit available for partners after deducting salaries and interest. Accurate computation is essential for compliance with tax laws and fair profit sharing. Remember, salaries and interest are taxable to the partner, and drawings are not taxable. Proper allocation ensures everyone gets their fair share and stays compliant.